Well, I'm Susan Burns. I'm the CEO and founder of Global Footprint Network. A little bit about Global Footprint Network. We've been around for 11 years. You're probably familiar with the ecological footprint. Basically, we're resource accountants. We measure everything, literally, everything produced, consumed, exported, and imported into over 200 countries and territories. And we've been working with governments mostly all of our history to help them manage resources. So, oh, and a little bit more about me, maybe? No.
A little bit, but you went louder.
Louder.
I think the room is the back, and
Okay.
it's a long session,
Okay.
so it helps people stay focused.
Great. Anyway, the overall premise, really, and the thing that we're really focused on mostly is that natural capital is a source of wealth for nations, and it also, the lack of natural capital and resource risks are increasingly having an impact on economies. So, and I'm going to tell you about one of our projects, which is working on to look at really the effect of resource risks on economic performance and therefore sovereign credit risk. So that's kind of where we're going with all this. But you know, I actually do think that resource risks are a new trend. I mean, of course, there have been environmental issues all along. But with increased consumption, population, the development of low-income countries coming into the global market, the competition for resources is completely unprecedented. So during the time when a lot of high-income countries developed, we did have ample natural capital to import from. And now the way that countries are developing, it really is a much tighter situation in terms of resource constraints. And nobody really knows what is going to happen with commodity prices. They do tend to fluctuate quite a bit, but we have seen that although commodity prices have slowly gone down over the last 100 years, I mean, since the early part of the century, commodity prices have risen in the last 10 years just to account for all of that decline. So some investors feel like that's a new normal. So how do we measure all this? It's the ecological footprint. Basically looks at humans' demand, all economies' demands for resources, whether it's forests to absorb our carbon dioxide, grazing land, cropland, and fisheries. And we also complement ecological footprint accounting with information on fossil fuels and metals and minerals. So it gives a fairly complete picture. So a couple of years ago, we were talking to some investors about whether how to integrate environmental risk into sovereign credit risk. And they basically said it's got to be material. You have to prove the material link, and it has to be significant. So we endeavored to discover exactly what the material link was. Oh, I don't have the map I wanted to show you. So one thing I wanted to say before I dive into that is that today, 80% of the world's population live in countries that demand more than their own domestic biocapacity can provide. That means they're very dependent on trade. Trade's a great thing, and so is the world economy. But to the extent that nations are dependent on resources from elsewhere, they can be exposed to trade-related risk and an economic risk because of that.
Sorry, Susan, was that 80%?
80% of the world lives in countries that demand more, and we call that ecological deficit or ecological debt. Yeah.
When you say that what they demand is more than what their countries can give, is that, how do you analyze the demand? Because you can talk about basic needs, and then that's a critical situation, or many things that we usually consume nowadays are not really needs, they're just.
Mm-hmm.
So how do you classify that demand?
It's just literally accounting, so looking at everything that's produced, everything that's consumed by either the economy, which is their the country's production footprint, or the consumption footprint, looking at what the individuals in that country consume. And it's everything from food to fiber to energy, it's all of that. And so the national footprint accounts are basically a big accounting system looking at both the assets of a country as well as the demands of the country. So it's like a balance sheet. And I wish I had that map, because that would be very handy to show.
We'll visualize.
Yeah, yeah. So we started out looking at looking at credit risk. I mean, it's kind of important to maybe take a step back and think of what are the three ways that a country can be in ecological deficit? How can it be demanding more than it actually can supply within its borders? Well, there's three ways, and that's how we really break down these risks. One is that, of course, it imports to make up the difference. The second is it could be depleting its own domestic biocapacity, like depleting its soils or cutting down its forests faster than they can be regenerated. And then the third is to emit carbon dioxide into the global commons. So it's really three things that are going on for countries. And each of them pose a risk in very different ways. So the reason why we started this project is because we think this is really a new and emerging risk. We were noticing that traditional country risk models don't adequately capture this risk. I mean, people often talk about the rating agencies, but it's also all kinds of credit risk, all kinds of country risk analysts also have been feeling a need to have this kind of analysis. And we aim to fill this gap because we felt that natural resource related risk is having an impact. What we found was that countries, number one, we did find that there were absolute material risks, that they were significant, and that they weren't evenly distributed among countries. So that was kind of an interesting finding. So basically how we did it was, number one, we look at the country's, I can't step away, sorry. We look at the country's overall resource balance, and then take a look in these three pillars. So what is the resource balance, and how does that affect their trade profile, which is in the first column? And the second is there over-harvesting going on? So recently, people have become concerned about Brazil, for example, and its decreased rainfall recently. They don't want to call it a drought, but if Brazil were to produce less in terms of forest products, that would have a big impact on its economy, for example. And then the third one is the carbon efficiency of an economy. And if indeed we do have a price on carbon, or we have regulation, there's a very wide variation among countries in terms of what it would take to reform those economies. Actually, the United States performs pretty poorly on all three of these. We have a lot of exposure on the trade side. We do deplete our own cropland and forests as well, and also the economy is very carbon intensive. So we look at these three risks, and then we look at them against the macroeconomic fundamentals. So what's the ability of that economy to absorb shocks? So on the trade side, we found that the exposure to resource price volatility, if you took a scenario that resource prices would increase by just 10%, you could see that for some of these countries, it could amount to 0.5% of GDP. A lot of times people talk about resource risk as being a long-term issue and not something that is happening in the short term, but with trade-related risk and supply disruption, that is actually happening currently. I mean, any day, commodity prices could rise. And so here are the top and the strongest countries, based on our analysis, for trade-related risk at the top there, and then I cut off the middle, and then you can see the countries that are most exposed on trade-related risk. The second one has to do with what I said, the depletion risk, the fact that countries can be degrading their own natural capital, and that can affect their trade balance, because if they're not producing as much, they need to import the balance. And so in the case of Turkey, just a 10% decrease in their production of crops and forests and fisheries could amount to almost 5% of their GDP. And one of the reasons that's the case is that agriculture makes up a huge part of their economy. So if they have impact there, that's also going to affect their GDP. Here are the countries that have the best performance for degradation-related risk, and then at the bottom are the worst performers. So I just wanted to compare and contrast real quick two different countries, just to give you a sense of how this works. I'm going to focus mostly on the middle two columns there, and India and Japan actually scored exactly the same, but for different reasons. So in the case of India, they're fairly exposed on the trade side because of fossil fuel. But on the degradation side, even more so, you can see it's much higher than Japan. And that's because they are depleting their local biocapacity, and agriculture makes up for half of the employment in the country. Whereas Japan, by contrast, is not depleting its own natural capital. It's mostly making up for that increased demand through imports, and agriculture is not a huge part of their economy. Japan, however, on the trade-related side, one of the reasons why it's at risk is that it's an ecological debtor, and its top 5 trading partners also are in ecological deficit. So that really does pose trade-related risk for them.
Are the numbers percentage of GDP impact?
Pardon me?
What do the numbers represent?
For GDP,
The impact of GDP?
for, let's see, for Japan? Did you say for? Yeah.
On your comparison slide between Japan and India.
Yeah, you can see it here, the degradation effect, the difference between the two.
And the GDP.
And the GDP is all along the x-axis, the left-hand side there. So it's about a percent.
On the side over here, it says
Of
percentage
GDP?
change at exports.
Did I answer your question?
Well, you said GDP, but it says net exports here.
Oh, okay. It's measured as GDP, as percentage of GDP. Yeah, sorry. It measured it as a percentage of GDP.
Well, maybe to clarify, she doesn't, this research, it focuses on environmental impact, not across the board housing and other manufacturing criteria. Is that correct?
Yeah, no, it's just,
It's more.
the GDP, we were just measuring it as a percentage of GDP, but this is how much it would affect their trade, their net exports.
So your GDP, you don't create your own metrics, you're incorporating the whole suite of GDP.
Yeah, no, we have our own metrics, but then we're translating them into terms that investors use. So,
Is that clear?
yeah.
'Cause there's always so many nuances of how one person does research that
Yeah.
will clarify a lot more about how.
So, and on the carbon side, there is a vast difference among countries in terms of their carbon intensity, both the carbon intensity of their whole economy, and also which sectors are mostly more carbon intense. So right now, this is a third pillar of research that we're still developing. But, it's increasingly important with the issue of stranded assets coming more and more into play. And also, a large percentage of fossil fuels are owned by countries instead of the oil and gas companies.
I understand the horizontal scale.
Of this?
Yeah, carbon intensity, the kilograms of CO2 per dollar of GDP.
Mm-hmm.
But what is the inefficient sector percentage? How do you qualify that? Because the France is low, I can understand, but why is Brazil, why is Japan so high?
So we look at what percentage of the economy is made up of carbon-intensive sectors. So we look at the overall intensity of the economy, but also we look at the carbon intensity of each sector, and then the percentage of inefficient sectors that make up the economy. So it's another view into what it would take to reform that economy, and which sectors would need to be reformed.
And what are the sector maybe a sampling of the sectors, how you break down this sector?
Very traditional, industrial sectors, pharmaceuticals, food,
We don't see Turkey as being a highly industrial country.
Yeah.
So I know that there's been huge projects to create cement factories there, companies, because they're rebuilding a great deal of housing along the default line. So
Yeah.
does that incorporate carbon? 'Cause
Yeah, I mean, everything, our accounts look at, basically use multi-regional input-output analysis, so we can look at the overall carbon footprint as well as how it plays out in each individual sector. So India has both a very carbon-intensive economy, and its economic activity is very dependent on it in terms of the percentage of the sectors in its economy that are
So
intensive.
by looking at this screen, what would, if you were about to invest in Turkey or Japan or India, from a macro perspective, what is your feelings?
Well, I would just say that
How would you
if you
approach
want to understand the risks to an economy in the future, this is one of the factors to take into account, is that, to the extent that an economy is really dependent on fossil fuels and very carbon-intensive activity, it just represents a higher cost potentially in the future to the economy.
it? Or also an investment opportunity if you have a company or corporation and you would like to enter those markets, I
Yeah.
guess, having a solution to whatever their challenges are.
Are you just saying that, for example, they are invested in that industry, let's say car manufacturing, or are you actually looking at the individual company to see what their carbon use is?
Oh, actually, we're looking at countries.
So you're just saying, okay, Japan obviously is a highly industrial society producing very industrialized products. So you're not actually saying that they're necessarily using as much energy as India is, but because they're in those sectors, you're giving them that rating.
I think it has to do, there are industrial economies that are less carbon intensive than other economies. In general, they're not all created equal. So, and so just some countries like Japan or Switzerland have much better carbon efficiency in general of their overall economy. Plus, their economies differ a lot in terms of dependence on these sectors. So,
We're going to have to move along.
Okay.
because I don't have a chance.
all right. Okay, so that's the presentation. Yeah.
I had a quick question. Bob, I just got an email yesterday, it was from Bob Costanza, it's updated his '97 study about, do you look at the value of ecosystems? Because he's now estimating it like $20 trillion a year of loss in
Yeah.
the economy from ecosystems being destroyed. Do
You know,
look at that in your analysis?
I think that's a really great question. We actually distinguish between economic impacts that are already baked in and those that are valuable but not actually valued right now. So for this particular study, we only looked at items that actually will affect an economy. So the fact that bees are pollinating is definitely valuable, but nobody's paying for that. It's not incorporated into any of the models that investors use. But commodity prices are, and the imports and exports of countries are definitely very material.